Hey everyone, in this video I'm going to highlight one fantastic growth stock that's down 83% off its high that I think you should buy right now. Now in the video I'll explain why I think that's the case. The stock I'm talking about right now is DocuSign, the electronic signature provider. So looking at this company, you can see revenue growth expanding from a little under 800 million in 2018 all the way up to nearly 2.6 billion in the most recent trailing 12-month period. Now, I love the electronic signature industry because I think it adds so much value to both sides of the equation. Consumers would prefer to sign documents electronically because you don't have to go to an office in person to get the document signed. It saves you time and hassle. On the enterprise side, it's cheaper to have your documents signed electronically. You don't have to have a person come into the office, and you don't have to have that person be watched and helped by one of your employees. Also, that process, that friction can cause you to lose a lot of sales, right? Imagine you're about to close a client, but in order to close that sale, the client has to come into the office to sign that document. Well, at that point, the client might say, you know what, forget about it. If I've got to drive in, it's a hot day, it's a lot of traffic, I don't want to bother, right? And so you might lose that sale versus if you can get that document signed electronically, boom, boom, a couple of seconds, document signed, sale made. And so both sides of the equation benefit from this transaction, not to mention how much the planet benefits from this, right? Think of how much paper will be saved if all signatures are done electronically. How many trees would be saved? Now that's significant. And so for all those reasons, I think DocuSign and the electronic signature industry overall will continue to grow. Now competition could increase. Several companies are coming in to provide the electronic signature product, and so it's not all the benefits are not going to flow to DocuSign, but it's going to be one of the companies that could benefit from the rising tailwind. The next reason why I think the stock is a buy is because it's used the revenue growth to increase profitability. It's demonstrated economies of scale here, going from major operating losses to operating profit margin positive 3.65% in the most recent quarter. So it's demonstrating economies of scale as it ramps up, and it's a company that the foundation, the business model, is significantly in favor of demonstrating economies in scale, right? The investments in the technology behind offering this service can scale across more customers, right? That next incremental customer doesn't cost DocuSign all that much money. It's the big upfront investment in the technology that DocuSign spends, and then incremental customers are just added to the bottom line. So it's in favor of reaching economies in scale. And already free cash flow is looking significantly better than it was before the outbreak, where free cash flow was less than 150 million every quarter, and now that's been updated and that's been increased all the way up to 469 million. As I mentioned earlier, a lot of that investment in developing this technology happened up front, and now DocuSign can sort of reap some of those benefits from a lot of that upfront investment, but it still needs to make incremental investments to update the technology. It can't just stop investing in the product, but not as much as it needed to invest initially to develop this product. Finally, the stock is not expensive. DocuSign is trading at a forward price to earnings of 19.45, the cheapest it's been since January of 2022. So you're getting this company with excellent fundamentals, growth in revenue, growth in profit margin, growth in cash flow, and you're getting it at a reasonable valuation. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.